Okay, so a while back, I had $1,000 sitting in my account doing nothing, and I did what any responsible, financially literate person would do. I Googled best investment for $1,000 and spent the next 3 hours watching videos of people in rented Lamborghinis telling me to buy crypto, which in hindsight was a sign. But underneath all that noise, there are genuinely useful answers to this question. Today, I want to break them down properly. What works, what doesn't, and what's quietly terrible for you even though it sounds sensible. And for those of us investing through a Sharia-compliant lens, some of the most obvious options here are a lot more complicated than they first appear. Let's get into it. The first thing most people suggest is a savings account. I get it, it's safe, the money's right there, you can pull it whenever you want. But the average savings account rate right now is around 4%. Your $1,000 becomes around $1,220 after 5 years. That is $1,200. That is not retirement. That is a slightly nicer grocery run. Then there's the certificate of deposit, the CD, which is basically a savings account that locks your money away for a fixed period in exchange for a slightly better rate. Slightly. At around 4.2%, you're looking at $1,230 after 5 years. I want to be kind about this. I cannot be kind about this. Now, here's what most explainers skip over. And if you care about being ethical or Sharia compliant, this is the part that actually matters. Both of these products run on interest. The bank pays you for depositing your money, then lends that same deposit out at a higher rate. That gap is the whole mechanism. In Islamic finance, that's riba, and it isn't a footnote buried in the fine print, it's the engine the product runs on. Think about what that means in practice. Someone is taking out a loan they can barely afford, paying 18% interest on it, and a sliver of that interest quietly trickles back to you as your 4% reward. From a number standpoint and a value standpoint, savings accounts and CDs are a skip, a scam, or whatever French word you would like to insert here. But that's not even the most interesting part. Let's talk about the stock market. Even at a spectacular 25% return, genuinely exceptional, most years the market doesn't do that. You're netting $250 on your $1,000. It's not nothing, but if this is your only $1,000 and you're not adding more, the math just doesn't scale. You need to keep feeding it. Which brings us to what I'm calling the income engine rule. The one thing Warren Buffett, Charlie Munger, and basically every serious long-term investor agrees on. The highest returning investment you can make is in yourself. Now, the thing you're probably thinking right now is, that's what people say when they don't have a real answer. For someone who hasn't looked at the numbers, you are right. I thought the same thing. But let's look at the actual numbers. Your income is the foundation. Index funds, REITs, portfolios, all of it is downstream from how much money you're generating in the first place. Take that $1,000 and spend it on a course that teaches you a skill companies will pay more for. Digital marketing, data analysis, financial modeling, and that skill gets you a $200 per month raise. You've just made a 240% annual return on that $1,000. No index fund touches that. No CDs in the same conversation. Buffett has said repeatedly that the best investment he ever made was a Dale Carnegie public speaking course in his early 20s. Not a stock, a course. The compounding on a skill is essentially unlimited. Every raise, every promotion, every client you can now pitch confidently is built on that base. And unlike a stock, no market crash takes it from you. So if you're sitting on $1,000 right now and you don't already have a stable growing income, books, courses, certifications, whatever closes the gap between where you are and what the market actually pays for, that's step one. Everything else comes after. Most people reverse this order. That's the mistake. Once you have that income engine running and you're generating surplus, money above what you need to live, that's when you put it to work. The most accessible starting point is index funds or exchange-traded funds. An index fund is a basket. Instead of buying one company's stock and hoping it doesn't blow up, you buy a tiny slice of hundreds of companies at once. The most well-known ones track the S&P 500 through funds like VOO or SPY. Even if 10 companies in that basket have a terrible year, the other 490 are probably fine, and the overall value keeps climbing. Historically, the S&P 500 has returned around 10% annually over the long run. Not guaranteed, but a much more reliable foundation than individual stock picking. Here's where it gets complicated if you're investing with Sharia compliance in mind. Standard index funds like VOO and SPY are not screened. They hold banks, insurance companies, alcohol producers, and weapons manufacturers. If that matters to you, what you want is a Shariah-Screened ETF. The two most widely discussed in the US market are SPUS, the SP Fund's S&P 500 Sharia Industry Exclusions ETF, and HLAL from Wahed. Both track versions of the US market with non-compliant companies removed and financial ratio screening applied. No screening methodology is perfect, and if you are strict during your religious inclination, you should check with your preferred scholar or screening service, but they're a legitimate starting point that gets you broad market exposure without the compliance headaches of just buying VOO and hoping for the best. The habit that actually matters with index funds is automation. Take a percentage of every paycheck, even 10%, and route it straight into your investment account before you can spend it. The research on this is clear. The people who build real wealth through the market are almost never the ones who time it perfectly. They're the ones who are consistent and boring for a very long time. I find that both reassuring and slightly depressing. Two main entry points here. The first is real estate crowdfunding, where you pool money with other investors to fund a property and earn a share of the rental income. The catch is liquidity. This money is tied up, sometimes for years. You can't pull it out because you had an unexpected expense. Treat it as genuinely long-term capital, not money you might need. The second is REITs, real estate investment trusts. These are companies that own income-producing real estate, and you buy shares in them exactly like stocks. By law, they must distribute at least 90% of their taxable income to shareholders, so the dividend yields tend to be attractive. Common ones recommended are VNQ and USRT. But here's what the standard REIT explainer leaves out, and it matters. Most conventional REITs carry heavy interest-bearing debt. Real estate development at scale almost always involves financing, and when that financing is structured around conventional loans, the income flowing to you as an investor has interest baked into it. Many scholars consider conventional REITs non-compliant on this basis, and when you look at the balance sheets of the major ones, the debt-to-asset ratios make that concern completely understandable. Some Sharia-compliant real estate platforms are emerging, but the options are still limited compared to the conventional market. Don't assume that because it's real estate, it's fine. It's not automatically fine. It's never automatically fine. Here's the one most people completely overlook, and I'm going to call it the guaranteed 18. Using that $1,000 to pay off high-interest debt. I know, it doesn't feel like investing, but let me give you the actual math, and then you tell me if it's boring. If you have a loan charging 18% interest, completely standard for credit card debt, and you pay off $1,000 of it, you have just earned an 18% return on that $1,000. Guaranteed. No market risk, no volatility, no waiting. The interest you're no longer paying is money that stays in your pocket every single month going forward. There is almost no investment on earth that offers a guaranteed 18% return with zero downside. The guaranteed 18 is that investment, and most people overlook it because it doesn't feel exciting. Turns out, the most powerful financial move available to you right now just looks like paying a bill. From an Islamic finance perspective, this one works cleanly. Eliminating interest payments from your own financial life, paying off interest-bearing loans as aggressively as possible, is mathematically smart and values consistent. The goal is to get to a place where your money works for you through ownership and genuine economic activity, not through interest compounding against you. If I were starting from $1,000 today, here's how I'd think about it. First, if you have high-interest debt, attack it. Anything above 6 or 7%, wipe it out. The guaranteed 18 beats most investment options at that level, and there's no risk attached. Second, invest in skills that directly raise your earning capacity. The income engine rule applies here. Your income is the foundation everything else is built on. Get that right before you worry about portfolios. Third, once you have consistent surplus, automate a portion into a Shariah-Screened index fund, SPUS or HLAL if compliance matters to you, and let time do its thing. Boring, consistent, and historically it works. Fourth, only consider REITs or real estate crowdfunding once you understand exactly what you're buying and have done the compliance screening if that's relevant, because real estate covers a huge range of structures with very different risk profiles. The category is not a pass. The common thread? Understand what you're buying before you buy it. Even Warren Buffett says the exact same thing when he talks about buying companies. And speaking of understanding what you're buying, if you've been thinking about tech stocks or software companies as part of your portfolio, there's something you need to watch first. The software sector just went through a brutal correction, and the reasons behind it reveal a lot about how these businesses actually work, and more importantly, what to look for before you touch any of them. I made a full video on that, the whole SaaS apocalypse story to date, and I'd strongly recommend watching it before you start picking software names. I'll link it here. If this was useful, let me know in the comments. What did you end up doing with your first $1,000? Because I would genuinely love to know if anyone else's answer was, I Googled it at midnight and watched crypto guys with rented cars, just to feel less alone.